Welcome, dear traders. Welcome to our weekly review of the crypto market. In the past 7 days, Bitcoin was on the rise, trading at $17,850 per coin. Yet the bull trend did not last long, and this is exactly what we are going to talk about in this video. Our previous video came the day after the FOMC meeting on a Wednesday. Back then, during his press conference, Fed Chair Jerome Powell said there would be no dovish reversal in 2023. And this week, other Fed officials, including Mary Daly, Loretta Mester, and John Williams, also warned investors against being overly optimistic. In its commitment to bringing inflation to the 2% target, the U.S. Central Bank is willing to stay hawkish for as long as needed. This is what market concluded from the interviews of the Fed policymakers. As a result, a bear trend emerged in the stock and the crypto markets. Once in a while, analysts point to the inverse correlation of a Bitcoin with the US dollar. Until now, it made sense when we saw an outflow of capital from risk assets to the safe haven US dollar. Now, fighting hot inflation, the American regulator is ready to cause a recession in the United States, which bodes no well for its national currency either. In other words, the greenback is no longer as reliable as it used to be, and investing in it poses the risk of losing funds. In addition, the Bank of Japan surprised market participants with its decision to expand its 10-year Japanese government bond yield target band on a Tuesday. The move is likely to pave the way for fine-tuning the current ultra-loose monetary policy. This news literally shocked the forex market. The Japanese yen instantly surged against the greenback, with the exchange rate of USD GPI plunging to 131 from 137 yen per dollar. Of course, the US dollar index stumbled against the basket of 6 major currencies too. On Wednesday, the USD index edged higher and traded at around 104.10 points, following the release of upbeat data in the United States. The U.S. current account deficit narrowed sharply by 9.1% in the third quarter, the smallest deficit in a year. Let's now see Bitcoin's reaction to those events. When the dollar began its bear run in an early Asian trade on Tuesday, Bitcoin started to grow from the level of $16,500. The price perked at $16,985 by the beginning of the North American session. A consolidation stage followed in the course of the North American session on Wednesday. The flagship cryptocurrency traded in a corridor between $16,780 and $16,919 when the greenback started to strengthen. BTC USD fell to $16,756, but then appreciated to $16,816. In the past 7 days, Bitcoin lost 5.2%. In the final 6 months of the year, the pair has been trading in an even narrower range between slightly above $18,000 and slightly below $16,000 per coin. It seems that the flagship cryptocurrency is now consolidating against the US dollar along with the rest of the risk assets. In the future, BTC will continue correlation with the risk stocks, especially from the Nasdaq list, as well as with the dollar. It lost approximately 8% in the past 7 days. On a Wednesday, it traded at $1,211 per coin. The weekly low and the high stand at $1,207 $1,207 and $1,225 respectively. Support is seen at around $1,150. Interestingly, Ethereum whales that have been dormant since 2018, have recently woken up. In addition, Ether saw an outflow of capital from the wallet address of the now collapsed Three Arrows Capital. However, according to experts, Ether has more growth potential than Bitcoin, as it's more stable. Most analysts link the end of the bearish cycle with the Fed's interest rates and expect to see the crypto market bottom by March 2023. In the meantime, many traders are now waiting the so-called Santa Claus rally, which takes place during the winter holidays. The Santa Claus rally is a calendar effect involving gains in the stock market that often take place at the end of December. The collapse of FTX and the arrest of its founder, Sam Bankman-Fried, have had an adverse effect on the entire crypto industry. The FTX fiasco has ruined the reputation of cryptocurrencies in the eyes of regulatory authorities that have been talking about the importance of crypto regulation for a while now. Following the FTX meltdown and the arrest of Bankman-Fried, regulatory authorities now have both the motive and energy to address these shortcomings. To some extent, this whole mess is of the ex-billionaire's own making. He constantly disinformed users in the media and social networks, thus building this distrust among regulators who control the market, the Justice Department said. On December 13, the Bahamian authorities arrested Bankman-Fried at the request of the US government, and the court denied Bankman-Fried's petition to be released on a $250,000 bails. He now faces up to 115 years in a prison if convicted on all 8 counts. The Biden administration believes that the digital asset space is unregulated and thinks that crypto firms can get away with anything. That is why federal regulators are eager to plant a flag and send a message. Renato Mariotti, former prosecutor for the U.S. Justice Department Securities and Commodities Fraud Unit, told CoinDesk. And at this slide, Binance, the world's largest cryptocurrency exchange, also came under scrutiny. Its CEO, Shangzhanji Zhao, reassured clients that Binance has enough liquidity to allow all of them to withdraw 100% of the assets if necessary. This has been our weekly review of the crypto market. Looking forward to your comments and the Santa Claus rally, and see you in our next video review. Take care.